Welcome to the Quorum Space at White & Case. I'm John Beverly, a partner in capital markets practice here and a member of the board of the Brazilian American Chamber of Commerce. We're thrilled to have you here. We have hosted a number of Brazilian American Chamber of Commerce events here in the past, and we're certainly happy to do it again.
Good morning all, and welcome. My name is Paulo Bacuna, and I'm the chairman of the Banking and Capital Markets Committee of the Chamber. As we meet, uncertainty is high and rising, and not only due to the shocking geopolitical events. For investors, the good news about the resilience of the U.S. economy is, paradoxically, a source of concern as it makes future action by the Fed even more uncertain. It also raises the prospects for higher for longer real rates, including in the longer end of the curve, where transition to Brazilian rates is more direct. And Brazil has its own uncertainties, mostly political, but also, of course, about its fragile and unsatisfactory macroeconomic regime. In particular, the fiscal framework approved in August reintroduces an era of high government spending, and this time around, funded not by the external bonanza, but by higher taxes. Worse, much of the spending is misdirected, given the administration's proclivity to populist approaches and its support of discredited developmentalist ideas. That said, comparatively, this is a good moment for Brazil. External demand for Brazilian exports is very strong, notably from China. Consumption remains robust in the aftermath of the COVID shock, and net capital formation is recovering. On the policy front, there are also good news, most importantly, the prospect of a structural tax reform. Despite the likelihood of damaging exemptions and of a prolonged transition period, when approved, the new system will reset the incentive framework for consumption and production, likely with a significant positive impact on food share growth.
Oh, good morning, everybody. Many thanks for the Brazilian American Chamber of Commerce White & Case. It's always a pleasure to be here. In the short term, the economy is doing relatively well. It was already doing well in the second half of 2022. It's basically the tailwind of the post-pandemic V-shaped recovery, facilitated by significant fiscal stimulus and the lagged effects of stimulative monetary policy. Then in the first quarter, the country was blessed with a super harvest, which certainly generated a significant amount of wealth and led to a very significant increase in GDP in the first quarter. That, allied with additional fiscal stimulus also led to a pretty decent second quarter. And that's pretty much where the story ends. Going forward, we expect to see a significant deceleration of the forward momentum of the economy. We expect the economy to decelerate, given that the global economy is decelerating. The tail effect of the reopening of the economy post-pandemic is also dwindling. The impact of tighter monetary policy is also fading at the margin. So the stars are kind of aligning for the economy, not necessarily to crash, but to go back to a path of relatively uninspiring growth. In terms of monetary policy, the central bank was quick off the marks in tightening monetary policy, is now in a stage where they are gradually easing monetary policy. The external backdrop will certainly impose a number of constraints on the speed and how far they can go with loosening the restrictive bias of monetary policy. We think that they will go into close to neutral or about neutral at the end of this cycle by the end of 2024. Of course, Fed policy, the exchange rate, global risk aversion will be key inputs into decision making alongside the dynamics of inflation on the ground. The key questions in terms of the medium and long term is growth. Growth has been disappointing for decades. The performance and the record is very uninspiring. We have done a chart that basically covers 50 years of growth, and we look at the opportunity set modeled as commodity prices and growth in China, and even in years where commodity prices double and China's GDP doubled, even in those decades, the Brazilian performance left a lot to be desired. So that's not necessarily a law from the heavens. It's just a reflection of the policy choices or the lack of them. Where reforms have not been materializing and productivity growth is pretty low. Investment has been traditionally very low, so that leads to relatively mediocre growth outcomes. This is a problem with a solution. Right? In the end, growth is about capital investment punto. If you don't invest, you don't grow. There is no David Copperfield trick about it. Right? And that's the missing lag in the Brazilian story is, capital spending, fixed gross capital formation that has been subpar. Investing 18% of GDP is not going to take you anywhere. Asia is investing more than 30. At certain points, China was investing more than 40% of GDP per year. So that was what was greasing the wheels of growth.
Good morning, everyone. Paulo, thanks for inviting me. Thanks for the opportunity. It's a pleasure to join such distinguished panelists the budget for next year. First comment here is that the starting point matters. So moving from a deficit in 2023 of about 1.1% of GDP or something around that, which is market consensus, to a balanced budget that is really, really challenging. Especially because, as you know, there is a lot of rigidities in the budget in Brazil. And more importantly, the new government introduced extra rigidity in the budget. I'm referring to the cash transfer program, Bolsa Família, for example. It will amount like above 1.5% of GDP. In the past, just to mention, it was around 0.4% of GDP, so it's a huge increase. We have this new rule for minimum wage adjustment. This time, actually in the past, there was this rule that was eliminated, and now we're bringing back this rule of adjusting the real minimum wage by GDP variation from two years before. This of course puts a big weight on spending. It's worth mentioning that above 50% of spending in Brazil somehow is linked to minimum wage. So there is a reasons for concern, especially because we're saying that minimum wage is no longer, they are really low in Brazil. There are implications for the labor market. It's not only fiscal implications. And of course, we're talking about an adjustment that goes ahead or above productivity gains. So there is a natural macroeconomic problem as well here. There is also the linkage of health and education disbursements or spending. There is a linkage to tax revenue. In the previous fiscal rule, the spending cap, this linkage was eliminated. And now, of course, once we don't have the spending cap, it was eliminated. This old rule for linking revenues to health and education spending is back. What else? Well, the framework, the fiscal framework, it also establishes a floor for investment spending of 0.6% of GDP. So we're creating extra rigidities in the budget. This is really concerning. It's not only for this year, actually, but we're talking about the years ahead of us. Well, regarding medium-term or long-term perspective, of course, my main concern here is the implementation of the fiscal framework. This fiscal framework, unfortunately, in my view, suffers with a kind of an internal inconsistency. Unless we have reforms to control or to reduce mandatory spending as a percentage of GDP. Unless we have structural reforms, which for now we don't have news on this front, despite the pressures that we see, for example, from the Congress, from the markets, but the point is, this rule of increasing expenses to 70% of increasing revenue is only feasible with a brutal increase of tax burden, which, as I already mentioned, this is really difficult. We're talking about a permanent increase in the tax burden of something like above 2% of GDP or so. And this is not feasible, so the idea, well, you put a cap on the spending, but the problem is that 93% or above that of the spending, 90% or so, is mandatory spending. And as I mentioned, the current government increased the rigidity in the budget.
Thanks for inviting me. From a rating perspective, we do two things. First of all, it's a little bit of a more medium-term view. Of course, I appreciate the medium-term perspective and less on the volatility of day-to-day or even year. But also you look at where Brazil has come from in this at this rating level and where it might be headed, and also a peer comparison. So I try to get a little bit into some peer comparison as I proceed. And if you look at the credit profile, two elements have always in a way stood out as problems or areas of weakness. First, since 2015, 16, if you remember, it went from a fiscal crisis to a fiscal problem, but there's always sort of a fiscal issue, at least always in my tenure, always in the last project. Started 2015. That's always there, and it ebbs and flows. Of course, it was a lot more acute earlier. But the series of reform that happened started with the spending ceiling, that put the brakes on spending, and that's where you saw, even after the pandemic, with very strong revenue performance related to inflation in some way, but also the really containment of spending. We had a primary surplus for 2 years in a row for the first time. The sustainability of that becomes a question, and all the issues with the new fiscal framework makes it, in a way, raises question as to when are we going to get back to that surplus performance. So the fiscal problem. The second problem, as Alberto mentioned, is the growth, which has been very weak and persistently disappointing before the pandemic. But I think not only in Brazil, we've seen it in other countries in the region, there has been a number of positive surprises in growth over the last 2 years. There are reasons for it. Maybe the fiscal impulse plays a role. Of course, the recovery from the pandemic plays a role. But we can also recall that there are a series of reforms that were meaningful, like the labor reform, the reform, stuff that has been happening, even with the starting with the spending ceiling over time, that may be also improving some of the underlying performance beyond the short-term impulse. So for us, we had 1% growth in 2018 until 2020 before the severe pandemic shock. I don't think we're going to have 1% growth necessarily going forward. So now we're looking maybe at 2%. It's not wonderful, but relative to where it was. So if you look at the few years before the pandemic, which was a severe shock, we're looking at shock and then the pandemic shock, I think we can maybe have better performance in the next few years after the pandemic. We had 3% growth last year, and now this year we'll probably be around that just because of the carryover. I'm not saying we'll have another 3% growth next year, but I don't think it's going to be 1%. So, I think we can look at maybe around 2%. Not stellar, but better. So, and that is the case for other countries also. So the two areas of concern, and they feed on each other. Of course, the fiscal problem also is helped or hurt by the growth performance. So when we see growth improving somewhat, that makes room for some adjustment.
The pleasure is all mine. Thank you so much, White Case, Brazil Chamber. It's a pleasure to speak to you. First of all, I think that the new measures presented by Minister Haddad to increase revenue, they probably will be approved, especially the offshore, the taxation of offshore companies, and the taxation of the closed funds, the exclusive funds, which are funds for the very wealthy in Brazil. And they should be approved on the week of the 24th. The JCP, which is then I mentioned, which is the taxation for the shareholders over capital, the government was trying to include this tax on the bill of the offshores to vote all together. The offshores, closed funds, and the JCP, but they were unsuccessful. I was with Aguinaldo Ribeiro, the rapporteur of the tax reform in the House of Representatives yesterday morning, and we were at an event, and he's also a leader, a party leader, and he told me that in the last meeting between the party leaders, there was absolutely no consensus about voting the JCP alongside these other measures. He said that the offshores and the funds should be voted and approved. But my expectation is that we could see even further changes to the text that will be approved. They're talking about a 22% taxation on the offshores. I think that when Pedro Paulo, who's the rapporteur of the bill, presents his final report, we could see this number going a little bit down, which would obviously affect negatively the revenue expectations of the economic team. I spoke just minutes ago, before we got in here in the meeting, with a member of the finance minister, and they are preparing a new document. They haven't quit with the JCP idea, and they're preparing a new bill of law, new text for the idea of ending the JCP, to present to Pedro Paulo to see that with this new text they can reduce the resistances and approve them all along. I think it's still unlikely. I spoke to several party leaders, to Pedro Paulo, to the minister, to the economic team, and my perception is that in this new text that the Fazenda, the finance team, will present, they might not end with JCP as they were initially thinking. They might change aspects of JCP to, in their words, reduce the distortions. But again, as Zena said, there's still a long way to go until we find the revenue necessary to reach the target of the government of having a zero deficit next year. In terms of the relationship between Congress and the executive, we're probably in the moment of history where the Congress in Brazil has been the most powerful and the most autonomous. This is an ongoing process that I think began maybe in the mid-2000s. One of the first variables that I remember of this empowerment of Congress was when Michel Temer, former president of Brazil, when he was Speaker of the House, he made some changes to provisional measures, which are the laws that are added and effective immediately, but have to be voted by Congress, confirmed by Congress. He made some changes to the provisional measures, reducing a little bit the power of the government. And from that moment on, especially during the Dilma years, because she antagonized the Congress so much that the Congress started protecting itself with measures to grow its autonomy, and that has never gone back. So now we have an extremely strong Congress, and the relationship will continue to be volatile. When we see Arthur Lira, for instance, there are multiple Arthur Liras in one. So in this year, we've seen the version of Arthur Lira that was very helpful to the government, for instance, in the fiscal framework. We've seen the version of Arthur Lira that was very difficult with the government, when the government tried to revoke some aspects of the sanitation framework, and he hit hard the government. There were moments where he was very aggressive, for instance, when he made changes to the provisional measure that reorganized the structure of the Brazilian government in the beginning of the mandate. There were moments when he was very constructive and proactive in helping find a solution, like the bill of law of the CAF. So there's multiple Arthur Liras in one, and when there's somewhat of a consensus designed, when it's something that is not seen as pure PT, pure Workers' Party, or too leftist, Arthur is able to design a way out and will be the key point of this relationship. But it will continue to be very volatile.
Thank you. Good morning. I'll be brief in the interest of time. try to grasp the implications of what we discussed so far. I'm going to start with Alberto. It's been a difficult world, more difficult now. That's worse and worse, but it's normally a good problem to have, and the U.S. is growing stronger than expected. It's not necessarily a good problem to have for emerging markets when the U.S. grows more than the others, and it's for a more synchronized world where the dollar strengthens, tightens financial conditions, and makes outlook for capital flows worse for a year. In the case of Brazil, there are good news. Central bank started earlier. The U.S. is late, not that Brazil is late. So that's and with tightening financial conditions, with rates very high in Brazil, with this sell-off we've seen, the starting conditions are much easier for the central bank in particular. But central bank and beyond, how do you see monetary policy unfolding and the main risks for growth and fiscal policy that unfolding over the year?
Sure, absolutely. In terms of the growth backdrop, and it's definitely a key input to monetary policy decisions. The economy is doing relatively well. We expect it to moderate going forward. We're operating at full employment. There is not that much slack left in the economy to grow much beyond 1.5%, perhaps 2%. We're still to be convinced that the reforms that were generated in took place really under potential GDP that much. We cannot grow that much without generating some sort of problems. On monetary policy, the external backdrop, you described it well. The U.S. economy is pretty resilient. The stance of the Fed has been quite conservative and signaling we are in an environment of a strong dollar, at least for a while longer. The recent events of the week can strengthen a little bit that dynamic. Capital inflows into the economy have not been that great. The external investor lost a little bit of interest in Brazil over the last few years. During the political transition, there was some renewed interest, but the external is still in the driver's seat. While we still don't have that much clarity where the dollar yield curve will settle, where the Fed is done or not done, what is the clear signal for eventual rate cuts towards the end of 2024. And there are very good dollar opportunities out there, perhaps bonds paying double digits, right? The interest in Brazil is limited. But when you kind of rank Brazil among the large investable EM peers, it's not a bad story in the short term, right? And if you look about Russia at war, China with a complex and disappointing reopening, South Africa with the usual shenanigans, Turkey moving more and more into an heterodox policy mix. Then you have basically Brazil and Mexico. Right, So it's not that Brazil is shining very bright; it's just the darkness around it that make it a little bit more attractive. But we haven't seen that inflows, and we won't see them. I would posit until we have more clarity about growth in U.S. Fed policy, and eventually the outlook for the dollar.
Okay, and also nice to see you. First of all, I agree with Samar regarding that a fiscal framework in Brazil without including measures to tackle or to control spending, of course, this will be inconsistent for any fiscal framework. This is not something peculiar to the current one. The difference compared to spending cap, aside from the fact that the spending cap was much easier to monitor, is a simpler proposal, much better for monitoring, social monitoring. But the point is, that politics matter. The difference now is that compared to what we had during the spending cap is that there is no commitment to reforms. When the spending cap was approved, the government said, well, we understand that this rule will only be sustainable if we cut spending. So we're approving a pension reform. So that was, this rhetoric is important. The signaling for the society, for the politicians, for the Congress is important, but that there is a commitment. This is why I believe that sooner or later, Haddad will need to bring this discussion. Of course, the timing for that will depend in part on market's reaction. If we consider, judging by the usual reaction of the markets, I think that if Fernando Haddad starts signaling reforms, I think markets will give the benefit of doubt.
What if things don't go according to plan? You know, we're talking about growth, mediocre, but let's say 1.5, somewhere it's 2, but in a world that's not going to be growing, Brazil will be okay. Not going to be much worse than the norm. But what if things don't go up according to plan and market pressure builds and the growth is slower than expected? How would this composition, this coalition respond to that?
There are risks on spending on the medium term. Before I specifically ask your question, I don't see them as much for next year. Or a lot of people ask me, can the government spend more because we have a municipal election next year? They could, but the Congress might hold that, because in municipal elections, the federal spending, it tends to impact much more the PT than the centrist parties. And in municipal elections, everyone's alone, fighting for their own seats for mayors. So the Congress might not be inclined to say yes to excessive government spending next year, because they will be afraid that such spending could boost the PT in their own fights against the PT that they will have normally in several mayoral runs. The biggest risk for spending that I see is near the election of 2026, because I think Lula will reach 2026 in a somewhat comfortable position in terms of governability and popularity. I think we will have a similar situation right now when it comes to governability, and somewhat similar when it comes to popularity. I don't see Lula regaining that amazing numbers that he had in 2006, 2008. More will have a meltdown of his popularity, like we witnessed with Dilma, then with Temer. He will keep around 35, 40 of positive support, then around 30 of regular, which historically in Brazil, those who believe that the government is doing a regular job, an important piece of those are potential voters. We often say here that in Brazil, in Brazilian politics, regular is almost love. And then you have the ones that reject him, 20, 25, 30%, that will keep being the same because of the polarization.
On the downside, I would be more concerned on growth disappointing, in the sense disappointing the government's aspirations. And this is where you end up with more pressure from the president, on the finance minister, on the economic policies, or more intervention in general, as Alberto mentioned, like the instruments of the state, right? You get into, and we had these concerns earlier that were not really materialized in a significant way, but really becoming more interventionist is the biggest risk. And then you end up with a worse policy mix, more programs, more subsidies, more. We don't expect that would be the scale of previous times, because there is no room, there is no fiscal room, and I think there will be a very strong market reaction. But still, it creates X. It doesn't support, if you will, policy continuity as we have seen it, say, in the last few years, or at least we have seen it recently, despite the gap.
Our panelists have been very, very generous with their time. I'd like to wrap it up now. They gave us excellent presentations, a lot to think about. And it's great seeing all of you, and thanks for coming. And thank you very much.
Yes, thank you.